on your report. Our team is kind of overseeing the balance sheet and the bank reconciliations and the overall financial health of Derek and NetGain's customers. So we are here as an extension, as a resource.
Any questions for Mo on any of that? Okay. So one thing that'll happen, so if you like, because we just have been doing the owner statement. So if you would like the others, let us know and we will be able to start uploading those to the owner portal and emailing those out as we send out the owner proceeds each month. So it'll be pretty easy with just a click of a button. But yeah, we want you guys to be able to have all the financial data that you need on your properties, so that you know how healthy that is and how it's working for you. So, which is one of the reasons I hired these guys. They've been fantastic, and as you can see, they bring a lot more to the table that'll benefit all of us with their reach. So
definitely. And yeah, as far as additional reports, we can definitely add them to the packets and the portals. And I could imagine, Derek, you probably get phone calls, especially around this time of year, or come tax season. Hey, can I get my 12-month income statement and other things and whatnot? And so I would suggest kind of like if we can provide these kind of like on a standardized and consistent basis, and that way you guys will have all this information at your fingertips whenever and if needed.
So
I have a question. Do you guys provide just a standardized end of the year that we could provide to our income tax people?
Yeah. Like an individual, like a financial packet specifically for tax purposes.
Yes, I find myself at the end of every year rolling through all of my costs for my rentals, even if it's cable and water and power and everything, and itemizing everything for my tax guy. I didn't know if that's something he always needs, or if you guys automatically provide something for like a 1099 or whatever it is.
Yeah. No, of course. I mean, the reason he's asking for these things is because these are potential write-offs that can be offset against the income the actual property is generating. So, but yes, these are definitely things that and this is something that we do offer, our clients. But yes, if there's a particular packet or like we also do taxes, but you most certainly don't have to use us. But to get all that information ready, what your CPA or your accountant, whoever's doing your taxes, is going to be looking for is basically kind of itemized detail on every transaction that's occurred so that they're classified correctly, and then secondarily ensure that they're capturing any potential items that can be written off or used as an offset against the income, including capital improvements.
Thank you. That answers my questions.
No problem.
yeah, you'll really be able to start seeing the impact of this partnership here over the next year. We're in the early stages, but there's a lot of things that we'll be able to do and we'll be able to provide for you guys. So on those lines, 1099s, we'll be able to get them all sent out by the end of the month to you guys. So those will be coming out, and then if you have any questions, we'll be able to work through them. And all the end of year statements will be sent out with your owner proceeds, which will be starting to be done after the conference today, since I was out of town and didn't get started on them yesterday with the weekend. So those will be all sent out today. You'll have the regular statement that I sent, and then the year end statement that we send, so that you can have that to your accountant, and I'll go ahead and include the income statement, year end, and that with it. So okay, so with that, I think Trevor Carlson is on. So thank you, Mo. We appreciate it. We'll turn it over to Trevor with an introduction. Trevor has been good friends of mine for years. When I was in the title industry, he was my first client. We know way too much about each other, but he is wicked smart with numbers and projections and everything. and knowing his stuff. So I'm super excited to share Trevor with you guys and his presentation. So I'll let him kind of introduce himself, what he does, and then move forward with the presentation.
Yeah, I appreciate it, Derek. So yes, so I am Trevor Carlson. As Derek mentioned, we have known and worked with each other for very many years, and obviously I would endorse and support Derek and his business. And I appreciate this opportunity to speak with you guys today. So I own Heritage Reverse Mortgage. I got into the mortgage industry in 2006. I started this company in 2016, but that's actually not what I'm going to be presenting today. Today, I'm going to give you information about the economy, interest rates, recession, and those kinds of things. And so let me see if I can pull up my presentation here so we can show you our slides. Rochelle, are you seeing my?
I don't see them yet.
Let's see here.
Just make sure to click on your correct.
Let's try that.
How
How about,
Yep.
you got it now?
Yep.
Okay, perfect. So as I mentioned, this is me, president of Heritage Reverse Mortgage. So I've been in mortgages for about 17 years. And I began my career just as the housing industry was going off the cliff, right? And so obviously, you know, during the time that was a rough time to be in mortgages, in real estate in general. But I look at it now as one of the fortunate factors of my career. You know, starting my business or starting my career in a down market has helped me to be better. It's helped me to pay attention to the things that matter. And so again, that's what I kind of want to share with you guys today is what I see going forward. Because, you know, there's a lot of question out there about, are we going into another housing crash, or do I need to sell my houses? Should I be buying more houses, and those kinds of things? And so I'm going to share my opinions on some of these things and the data that drives those opinions. And then that way, hopefully you can take that information and continue to increase your own wealth as professionals and as investors. And so as I mentioned today, we're going to start off by oh, come on. For some reason, it does not want to catch up with me. There we go. So rates, real estate, and recession. And so the first thing we're going to talk about is a recession coming in 2023. And if you are still on the fence with this, I want to prove to you inconclusively that yes, we're going to have a recession in 2023. The politicians and those on the media will finally admit that we are in a recession. And I'll explain why I feel so strongly about that. But if you were a professional during 2008, the word recession is probably something that scares you. And I'm hoping to change your mind on that, right? A recession can be a fantastic opportunity if you know how to take advantage of it. And so that's kind of what I want to help you do today. So the big question is, what's causing the recession? And the simple answer is inflation, right? But it's not just inflation, it's interest rates. When I talk about interest rates and inflation today, I want you to kind of imagine a dog and its tail, right? Because interest rates will always follow inflation, just like a tail follows a dog. And so if inflation goes up, interest rates will go up. If inflation goes down, interest rates will likewise go down. And so if you need to forecast the future of your properties or your investments and how interest rates play into those, look at inflation first, okay? What's driving long-term interest rates? It is, well, right now it feels like Lloyd's driving the car, but in reality, these people are driving long-term interest rates, but it's not how you think. Most people think that when the Fed raises the Fed funds rate, that means that they're raising mortgage interest rates, and that actually is not true. There is somewhat of a correlation there, but in reality, what we typically see is that when the Fed raises the Fed funds rate, the immediate response in the mortgage-backed securities is an improvement, and so interest rates actually go down. So looking at historical patterns, this kind of helps us to foresee the future. And I'm going to show you two recessions and what happened with inflation. But this principle and this pattern holds true for every recession over the past 50 years, at least. And so in 1980, Burns and Volcker were the Fed chairman. Inflation spiked from 7 to 14%. Mortgage rates, like a tail following the dog, followed suit. Interest rates spiked from 12 to 18% almost overnight. The Fed responded by raising the Fed funds rate from 11 to 20%. And the immediate response was inflation curtailed, right? Dropping from 14 to 5%. Mortgage rates likewise followed from 18 to 12%, and we experienced a recession, okay? Same thing again in 2000 with Alan Greenspan. Inflation doubled from 1.75 to 3.5. Mortgage rates went up from 7 to 8.5. The Fed funds rate likewise was raised to counter these results or these issues. Inflation fell, mortgage interest rates fell. We went into a recession. Okay, and so this is the pattern. This is the predictable pattern of what we've experienced in every recession over the past 50 to 70 years at least. And I don't go beyond that because, of course, the data beyond that is somewhat questionable. So what's happening today? Jerome Powell, inflation has shot up from 1.5 to 8.5%. Fortunately, we peaked in November. We have already peaked on inflation, so we're on the way down, okay? Mortgage interest rates likewise went from 2.5% to 7.5% in less than a year. And likewise, those peaked in November. They're on the fall again to, right now we're at about 6.25 to 6.5. The Fed funds rate has been raised from 0 to 4.5. It will continue to go up. Unfortunately, I think this is a bad idea. I think the Fed is doing what the Fed does and they overshoot things, but it is what it is. The Fed is going to continue to raise the Fed funds rate, and the result of their actions is causing inflation to stall out. Inflation is falling, unemployment is going to start rising, and we're going into a recession, as I mentioned. But again, predictably, this could pose an opportunity for people who are ready to take advantage of it. So what will happen with mortgage rates? Likewise, they fall, again, predictably. Right now, to date, we're down about 21% in the stock market. And again, I think as the real data of unemployment begins coming out, I think we'll see more drops in the stock market. I don't know how big they'll be. I'm not going to make any predictions there. That's not my area of expertise, but for sure, I would say that we'll see some falling there. Now, before I go on, I need to explain something that is important, and this will be helpful for you going forward. If ever you need to predict a recession and opportunities to buy real estate, the yield curve is a good one to watch, specifically the U.S. Treasury yield curve. Now, this curve that I'm showing you is just a standard yield curve. This is how yield curves work. And basic idea of this is that if I go to the bank and I buy a CD, if I'm going to give the bank my money for a longer term, say 5 years, I expect that they're going to give me a higher return than if I were to do a 6-month CD, right? And so that's a normal yield curve. That's how the market should function. If I give the bank money for longer periods, they should pay me more in return. But what happens is that when the economy gets wonky, then the yield curves of the Treasury, the US Treasury, get inverted. And it actually looks something like this. And so this chart shows you the yield curve inversion of the 2-year versus the 10-year Treasury over the past 50 years. Okay, and so let me just kind of explain what you're going to see in this chart. You're going to see variations of this chart throughout my presentation. These grayed areas right here indicate recessionary periods. The green areas are when the yield curve is normal, where you would get a higher return for a 10-year versus a 2-year Treasury. But the red curve, or the red section, is when those yields get inverted, meaning that I could invest in a 6-month or a 2-year Treasury today and actually make more money than investing in a 10-year Treasury. And so predictably, here's what happens. Every time the economy gets wonky, the yield, the economy knows that something's wrong, and the Treasury gets inverted. And so in 1980, Treasury goes inverted, immediately following recession. Inverted, recession. Again in 1990, inversion, recession, inversion, recession, inversion, recession. And so predictably, this happens every single time. Whenever the Treasury gets inverted, it means the economy is trying to tell us something's not right, and we're headed for a recession. We are more inverted right now on the yield of the Treasury than we've been since 1983. okay? And so they keep telling us we're not headed for recession. Unemployment is at all-time lows, and the economy is strong, and we have so much to look forward to. And that's my favorite argument. When they talk about unemployment and that being the reason why we're not headed for a recession, this is the chart that I think about. So this goes back to 1950. And likewise, it's showing you the relationship of recessionary periods, as indicated in the gray, and the unemployment rate, as indicated by the blue line. And so what happens before every single recession? Unemployment bottoms out. It is at its lowest point of the cycle. And so you have low unemployment recession, et cetera. Every single recession ever has low unemployment right before we enter recession. Yes, during the recession, unemployment will spike, right? But this is exactly what's happening now. And so when you hear on the news that, no, the economy's okay, we're going to be fine, we're not going for a recession, I'm sorry, but history tells us that what they're telling you is wrong, okay? Now, are you scared yet? So again, as I mentioned, most people who were adults during 2008's real estate crash think they associate recession with housing market bubble and massive losses of wealth and those types of things. But the good news is that 2008 was a bit of an anomaly. That's not normally how recessions affect real estate. And so let me kind of walk you through what I see are the differences of 2008 to 2023 and why we will not experience a housing crash this year. And so some analysts like to use this chart. This shows housing inventory last year. And this is one of their arguments, is that inventory, or the number of homes nationally that are for sale, was spiking in August, right? Oh, inventory is going up, people aren't buying homes, interest rates are through the roof, we're heading for a market crash. What they don't show you is the long-term view. This is the same statistic, but backtracked over 10 years. And what you see here is that is a predictable pattern. Housing inventory always spikes in August, and it always plummets or dips in January and February. This has happened every single year since forever, right? What they don't tell you is that even with our inventory being slightly higher this year than last year, we're still 1 million homes less than in 2015 and 16, and 2 million homes less on the market than we had in 2008, right? And so the idea that inventory going up is a bad thing is actually not true. The reality is that I went to a conference a couple of months ago, and Mike Lee was speaking. And one of the statistics that he gave is he says that in America today, we are 20 million homes short of demand. 20 million homes are needed right now today to fill the current demand for housing in America. And that number grows by about 1.5 million people every year, because that's how many people are entering the housing market. They're reaching adulthood, they're needing a home for their family. And so I need you to understand this, that demand for housing right now today is higher than it has ever been in this country. And so the idea that we're heading for a market crash because people don't want to buy houses anymore is completely false. There is more demand now than the market can really put up with. So 2023 is definitely not 2008. This is another one that I want you to kind of look at that contrasts 2008 from 2023. We peaked, the highest level of inventory ever was in 2007. 3.7 million homes were on the market in 2007. The lowest point ever was actually this last year, right? Less than 1 million homes on the market this last year before interest rates shot up. And so again, this indicates that the problem isn't demand. We have plenty of demand. We just don't have the affordability because interest rates have gone up. This is another chart that I find interesting. And so these graphs, these bars here, the blue one indicates new household formations, meaning little Johnny's grown up, he's moved out of the house, he needs a place to live, right? And so new household formations is indicated in the blue. The number of households actually built is indicated in the orange. And so look at this, leading up to 2007, 8, and 9, there was a massive disparity. Home builders were building far more homes than we needed, right? There was a ton of speculation. And so there was opportunity to buy anything, anywhere, right? Things leveled off in 10, 11, 12, 13, 14, 15, where builders were building roughly about as many homes as we needed to fill the demand. And then again in 2017, that ratio reversed itself. And for the past 6-7 years, home builders have been building far less homes than we actually need just to fill the demand of new people coming into the market wanting to buy a home. And so this is important going forward, because this is giving you indicators in terms of what's going to happen to your home's appreciation going forward. People are saying, well, home values are going to start going down. And I'm telling you the opposite is true. Home values are going to go up again. Consider this year, I don't have the most recent data, but home builders by and large have been on pause because nobody's buying homes. Interest rates are too high. They can't build homes because they can't sell them. But we're still increasing the number of new households that are needed this year. And so remember that in terms of demand going forward. Foreclosure rates is another key indicator of our economy versus 2008. 2008, 9, and 10, we had record foreclosure rates. And so if you can imagine what happened here, people were buying homes with little to nothing down. They had adjustable rate mortgages. They were speculating and buying 3, 4, 5, 6, 7 homes that they would flip in 6 months. And so when the market turned and these people were stuck with these homes that were going upside down, they immediately gave them back to the bank. They were immediately foreclosing on their homes. And so the bank, of course, is hit with this onslaught of new homes, and they have to go into a fire sale to get rid of all of these homes. That's why values in 2008 plummeted by 30, 40, 50%, is because the banks were overloading the market with inventory and nobody was buying. And so the values had to fall to reach market equilibrium. But look at today. 2021 had record low foreclosure rates. And I know that the stimulus of COVID helped with this, but we don't have stimulus anymore. And yet our foreclosure rates are still at record low levels. Why is that happening? Well, the difference is that today, most homeowners, one of the analysts I follow said this the other day, he said, and I don't know if this data is true, I haven't fact checked him on this, but he's a smart guy, and so I kind of trust him. He said that 60% plus of all mortgages that exist today have a fixed interest rate with a number that starts with a 2 or a 3. Now consider that. Most mortgages in America today have an interest rate that are below 4%, right? Not only that, but another key point to consider is that the average amount of equity that homeowners in America enjoy today because of the appreciation we've experienced over the past 10 years is roughly 50%. That's why people are not foreclosing on their homes. They have a low interest rate on a mortgage they can afford, and they have 30, 40, 50% equity. They have hundreds of thousands of dollars of equity in their homes. Why would they foreclose on their homes? And so people keep saying, well, we're going into another market crash. It's not going to happen. Because who's going to foreclose on a home that they have $200,000 of equity in? If anything, they'll take a 10% haircut on the home. They'll sell it with a realtor, and our market may correct by 5, maybe 10%. We're not going to have a 30 or 40% reduction in home values. Okay. So what will happen? Well, did you know? Now, again, as I mentioned in the beginning, most people associate recession with housing market crash. 8 of the last 9 recessions actually saw housing stimulated. And why does this happen? And so look at this. In 1960, housing values were level. In 70, housing values went up. 72, they went up. 80, they went up. 83, they went up. Every single recession except one actually saw home values increase during the recession. Why does this happen? Because every time we go into a recession, we also enjoy lower interest rates, right? It goes back to what I was saying in the beginning. We have high inflation. The Fed gets involved and they try to fight that inflation with raising the Fed funds rate. That puts our economy into a recession, and the recession always brings lower interest rates, which supports demand, which supports home ownership, which allows more people to buy a home and actually pushes home values up. Okay, and so this has happened every single time over the past 50 years. We go into a recession, interest rates fall, demand for housing recovers, and people buy homes, which pushes home values up. So I'm going to kind of jump through this. I've got just a few minutes left. This is some data that I subscribe to that I think would be helpful for you if you own property in Iron County. This is from a site called MBS Highway. It's a site that I follow, interest rates and economic data and those kinds of things. So some of the things on here that I think are fascinating. The median home price in Iron County is $426. The expected gain on that over the next 5 years is about 21%, or $92,000. Historically, over the past 63 years, if you owned a home in Iron County, you average 4.1% appreciation every year. Over the past 10 years, that number is just under 7%. Sorry, I'm not showing you what I'm looking at. I'm over here in this bottom left corner. Over the past 5 years, you've averaged almost 10% appreciation for homes in Iron County. Looking forward, yes, the next 1 year will be right at about level. Some homes may lose 5%, some homes may gain 3 to 4%, but on average, we're right about 1 to 2% appreciation in Iron County is what is expected. Over the next 5 years, as I mentioned, we'll get back to normal and you'll have about a 21, 22% appreciation rate. Employment in Iron County is solid. It's always been solid. It's a vibrant and growing economy, and it's looking good for the future. Unemployment is under 2%. It's a very strong economy. This is another one that I'd love to show you. Since 1991, this is appreciation in America since 1991. The #1 state in America at almost 600% appreciation over the past 30 years, Utah. Over the past 5 years, Utah is #2, second only to Idaho at about 90%. Over the past year, we're at a measly 10% appreciation. And so again, the point of these charts is to show you that owning homes in Iron County and Utah, very sound investment. It is likely going to continue to be a sound investment into the long-term future. So to finish off, just to tell you a little bit about my company, I like to follow this axiom by Stephen H. Schwarzman. He says, if you want to be successful, find a big problem and solve it. The bigger the problem, the bigger the reward. And the problem that I'm endeavoring to solve is retirement. Retirement in America is shameful, to be frank. According to Forbes, in 2019, the median net worth of retirees aged 65 to 74 was $266,000. Their median net worth was $266,000. And of that, $240,000 was locked up in their home. And so that essentially means that if you're retiring today, you've got about $25,000 in the bank and a couple $100,000 of equity in your home to survive you another 20 to 30 years without working. To make matters worse, Social Security publishes this information. They state that over 60% of retirees rely on Social Security as their primary source of income. And the average check from Social Security in 2021 was about $1,500. And so, as I mentioned previously, the average retiree in America right now lives on a fixed income of about $3,000 a month, and they have about $25,000 in the bank, and they're going to live another 30 years, 20 years on average. And so for me, this is my purpose. My vision for my company is to focus on doing one thing and to be the very best at it. And so we do home equity conversion mortgages, reverse mortgages, as you probably know them. And our focus is to help people to correct their finances, to improve their finances by using the equity in their home. And so with the home equity conversion mortgage, we're able to use the equity in their home to eliminate mortgage payments. They pay their taxes and insurance every year, but we eliminate their mortgage payment. We can consolidate debt. We can access tens of thousands of dollars of equity that they can draw out. And when they pass away, after 20 years, there's still going to be hundreds of thousands of dollars of equity left in these homes for their family to inherit. And so if you've heard anything about reverse mortgages and it sounds a little off, you've probably heard about the old reverse mortgages. And it would for sure be a worthy conversation for us to explain to you how the new reverse mortgage works, what's changed in the product. In my opinion and in my experience, we've helped now about 1,500 people do a reverse mortgage, and it is life-changing. It helps people to correct their situation, their finances, to live with greater freedom and flexibility, to have greater hope for the future and less fear of the unknown. And so especially right now with high inflation and recession and those kinds of things, I love what I do. We're helping a lot of people and we really enjoy that. So I'm sorry I've kind of buzzed through this. Any questions that anyone has?
Trevor, this is Camille Dickerson. Do you
Yeah.
handle loans in Weber County in northern Utah?
I do, yes.
Okay.
So I'm licensed in 12 states, so we can do all of Utah. And in fact, Camille, to answer your question, so obviously as a mortgage professional, I understand the industry, whether it's a reverse mortgage or a forward mortgage. I'm always willing to give my advice. If it is a regular forward mortgage, I'll typically refer clients to a friend of mine in the industry because again, I just do the one thing that I do so I can be the best at it. But we have people that we can refer you to as well if that's not the route you want to go.
Excellent. Thank you so much.
Okay.